Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook. All right, so this interview, I sat down with Emily Cortright and Adam Roberts. I met them when I first started my multifamily journey several years ago. They are amazing. They're actually one of the reasons, and I did not mention this to them on the interview, but they're actually one of the reasons that I wanted to leave my job so early. They both had engineered jobs, really good jobs. And they stepped away from that because they got into real estate and investment properties. And I was like, well, shoot, if there's two really good high-paying jobs and they left for real estate, there must be something there. Anyway, you're going to love this episode. They both bring a ton of knowledge to the audience and in the interview. Hope you enjoy it. Thanks. Welcome to the Passive Investors Playbook, where we talk to successful people about why they got into real estate. I'm your host, Charlie Hardage. Today, I have two special guests, Emily Cortright and Adam Roberts. They're the owners and managing partners of A&E Real Estate Group. Emily and Adam were both working at General Electric as engineers in operations and supply chain prior to real estate. They were both on a significant corporate track and both had a future vision of being GE executives someday. In 2013, Emily left her job and started investing in real estate, starting with single-family flip and rental properties in the DFW area. In 2018, Adam joined Emily by leaving his job to help run the real estate business in a full-time capacity. Overall, they have owned 23 multifamily properties. Several of those have already sold, valued at over $220 million. They're based in the Dallas-Fort Worth area, where Emily is also a real estate agent that leads the wealth building mastermind group in her office. Outside of real estate, Adam enjoys piloting small aircraft as well as being a flight instructor. He plays in a country music band on the weekends, and they enjoy traveling to see friends and family. They have helped over 1,000 people passively invest in real estate and help others achieve financial freedom. Emily, Adam, I'm super excited to have you on the show today. Thank you so much for being here. Do you mind telling the audience a little bit more about your background?
Hi, Charlie. Thank you so much for having us. Again, my name is Emily Cortright. This is my husband, Adam Roberts. And yeah, we were climbing the corporate ladder and really chasing the next fancy job title, moving around the country with General Electric, when Adam invited me to an investing class. And I show up and it's a real estate investing class. And I look at him, I'm like, what are we doing here? Like, we're not going to invest in real estate. And he just looks at me, and goes, no, just come in, just listen. He had read Rich Dad, Poor Dad prior to that.
Nice.
And so there was a little bit of a real estate bug. And that 2-hour class literally changed our lives. It started that quest for knowledge, and it showed us that real estate has the potential to provide a financial security for our future. So it just happened that within a year after that class, we ended up getting sold as part of a GE divestiture. They were selling off a series of facilities, and that was the perfect opportunity for us to move from Southern California, where we were working for our work rotation, to Texas. And when we did that, I quit my job to start our real estate investing business.
That's great. Okay, so there was a, Adam, you had read Rich Dad, Poor Dad. Was it a Rich Dad, Poor Dad investing seminar that you went to?
It was actually.
Okay.
It was a Robert Kiyosaki, it was like a feeder event that got you into their weekend course. And so we went to the weekend course, and, your mind's blown. You're like, oh my gosh, I can't believe people make money doing this. And so that's what started it all.
Wow, that's amazing. I went to one of those in, I think it was 2013 or so.
Mhm. That same year for
yeah.
us. Yeah.
Yeah, I went to one of those. I think it was a free event, and then you paid like $100 or something to go to the 2 or 3 day course. Of course, I paid for it, but I didn't attend the course. So anyway,
Oh.
there's that. But that's really cool, and I kind of felt the same vibe that you both felt. Wait, this is too good to be true, right? You know, I had been interested in real estate at the time, but didn't really know how to make money, and so that's cool that you guys both went to that course as well, and just kind of lit a little fire, I guess, under you and started that. So that was about 2012, is that right?
Mm-hmm.
Okay, and then 2013, GE divested your business line or your product line. You moved to Dallas. Emily, you say no. I'm good. No more GE. I'm sold on real estate. Is that pretty much it?
It's funny. We both worked for GE for quite a while, internships, early career. So it was pretty devastating at first. We thought, oh my gosh, like, what did we do? We did something wrong. Now we have to go back into the, interview and find other companies to work for. And, I think to Emily's point, it was really good timing to take a risk. You could live in Texas, you could live on one income, so I kept a W-2 job. We lived modestly on one income while we built the real estate business. And Emily was pretty much running that whole show.
Yeah. And we had the mentality that if it didn't work out, I could always go back and get an engineering job.
Yeah.
So there was never a concern that we were going to have to move back in with mom and dad. It was like, worst case, I'll just go back and get another job.
Yeah. I love that story. It kind of seems like a really good natural time to take a risk, because you already had to move anyway. Might as well take the risk. And it wasn't a big risk, because like you said, Emily, you could have gotten another job, take a few months off, take a year off, whatever it was, and go back to work as an engineer. But you didn't. You got into fix and flips. You got into rentals. Let's kind of talk about that. What led you to the fix and flip versus multifamily versus wholesaling? Why fix and flip?
We did a little bit of all of it. Our first purchase was a fourplex that we bought on the MLS, and we held that for 9 years. And then our other strategy was really to flip one, make about 20 to 30,000, and then buy a rental. And so we did that for a couple of years, flip one, buy one, flip one, buy one, and really had a good mix of assets that we sold quickly and assets we held. So we got up to 11 single family rentals that I self-managed, and we wholesaled a couple. That was just more so when we would get in there and felt like the work scope was a little more than we wanted to handle. And so we would wholesale it. And we also did a subject to purchase. So a little bit of everything.
Yeah.
But it kept feeling like a grind. And it got to the point where HGTV was getting really popular. There was a lot of competition coming into the single family investing space. This was around 2016, 2017. And I was spending too much of my time being that hands-on landlord. And I wasn't very good at the time at leveraging property management, leveraging an assistant, anything like that. So I was getting burnt out pretty quickly. And we had some friends that had invested in multifamily, and they said, hey, you need to come and learn about this. So we attended a weekend course for multifamily investing. And that was really the second light bulb that went off in our heads that said, this is where we need to take our business. It's the next level of sophistication for us. It's the next level of complexity. And it's going to get me from that landlord position to the business owner role.
I love that. I've heard that story a lot of different times where people maybe start in single family. I think most of the people I've spoken to have started in single family. And it always seems that it's a lot of work for a little bit of a return. And so how, the next kind of question in their mind is, how can I scale? And it seems like multifamily is kind of the best of both worlds there, where you can scale, but it's still real estate. So I love that story. So Adam, you were still working full time at this point. How involved were you with the real estate business, or was that all Emily?
Yeah, I mean, Emily was definitely driving the ship. And the way that I made it work was I would essentially spend the first half of my day working my job. I worked in, I stayed in the aerospace industry. I stayed in aerospace manufacturing, supply chain. So I had to be on site. There was no working from home type thing.
Sure.
But I would, 7 a.m. till noon, I would just crush it, just getting stuff done for the company I worked for. And then when I could get away in the afternoon, I would do real estate as much as I could. And so I learned to be pretty efficient, and I would do things that, because Emily held her real estate's license, which we found to be very productive and advantageous in the single family world. Because Emily held her license, I did things for the business that, say, agents wouldn't be able to do, right? Due to disclosure laws or, client, house laws. So like I would go talk to sellers and have conversations about buying their home instead of listing it, right? Things of that nature. So we found ways for me to participate, and I think it was a good match.
Yeah, it was a great match.
Mm-hmm.
I'm very curious about, so you're married, been married for a while. How, and the reason I ask this question is because I know a lot of times one person may be interested in real estate and their partner may not be. Were you both on the same page back in 2013? And how have you been able to kind of build that business as business partners, but also as a married couple?
We did have the same vision, and it stemmed from both of us seeing the numbers and seeing the potential that real estate can provide. And it's really a means to an end. Like, how is real estate going to provide that financial freedom that we all dream of? And so when Adam was able to join me full time, the first year we both did the same roles. We were both active asset managers for the apartment complex that we had just bought. And it was great because we both learned the whole business. We learned every role back and forth, but we started stepping on each other's toes. So within a year, we started benchmarking other successful married couples who were in the business. And we learned from them that we really needed to have distinct roles and responsibilities. And so it was January, and we said, this year's going to be different. And we separated our roles and we said, what are you going to do? What am I going to do? And we made distinct swim lanes for each of us. And since then, it has worked out very well. There's been a lot less butting heads because we have very different management styles. And there were times when we needed like a mediator to tell us which way do we need to go and how do we need to handle this. But now it's like, this is my role. I'll take your feedback, but this is how I'm going to handle it. And so that has helped a lot and has really alleviated some of that friction.
That's amazing. Who's the better manager? No, don't answer that. Okay,
Who's
so
the nicer manager? No, I'm kidding.
Emily raised her hand. If you're not watching online, she raised her hand saying she's a nicer manager, and I would have to agree with that.
Probably would agree with that.
Okay,
Yeah.
okay, so that's three of us. So you both were like-minded in saying that real estate is an ends to a mean. Is that right? A mean to an ends? And
Means to an end. You got it. Could be both, actually.
All right. Well, we'll have to look that up. No, it's a means to an end. But you had different management styles doing a very similar role. And so you kind of talked about it and said, okay, we have to, you talked about it with the two of you, then talked to other successful couples doing very similar jobs and roles. And you came up with, hey, we have to have kind of like a game plan going forward. We can't be doing the same thing. How's that worked out since you kind of divided and conquered?
It's been really, really productive. I think it's efficiency is the biggest thing that comes out of that. It's hey, I know that I can go work on my swim lane without feeling like I need to check with Emily. Hey, you think we should do this or that? What do you think? There's a level of trust built up there. I think for me personally, it's been a great learning experience because, I don't think I ever lacked trust or in Emily's judgment, but when you see somebody that you're close with, like your spouse, just, take a business responsibility and run with it, and is successful at it, it's just like, wow, she's good at that. And we should just let her go, do what she thinks is the right thing to do. And then you hope that she feels the same way about the way that I manage things too. And with that, it's just magical, right? Things just happen, deals get done, things get managed, and things of that nature. So it's been very, I would say, efficient is the best way to describe it.
And the way we split it up was Adam became more of the front facing operations. Like he would be on the calls with the property management company. He would manage the CapEx, more of like the on-site items. I did more of the back end. So I did the banking. I did the investor distributions, I would draft the investor newsletters, the emails, and everything like that. So it was kind of like the back end and then the front end. And that was a really good way to split it up.
Yeah, that's great. And just for the audience, in multifamily syndication, there's a lot of different roles. Primarily in single family and the small single families that they had, Emily was doing most of the work by herself or with Adam's help, but for the most part by herself. And, it can be a grind, and the things that you're not good at, you still have to do, right? With single family, but with multifamily, there's teams, whether it's 3 people, whether it's 10 people, whatever the number is, there's a lot of people. And so there's a lot of different roles, responsibilities. And what's great about the multifamily syndication space is you really only have to focus on your strengths because you bring in other people to augment maybe your weaknesses. And so I love that, Emily, you talked about kind of the front facing, the back facing. There's a lot of different things that goes into these roles. And again, still speaking to the audience, the asset management side, we call it asset management, but in a corporate world, you may call it like project management, right? Where you're managing the projects, you're managing the rehab, you're managing the asset, the apartment complex. And Adam, what I really liked what you said is kind of, taking a step back, looking at Emily and just, maybe it sounds a little cheesy, but just kind of being proud of like the work she did. And I see that with my wife and with my child, just kind of taking a step back and being like, man, that's so awesome that, they are doing way better than I would do, or thriving in this role. And it just kind of makes you proud, as a husband or a father. So love that story. I can so relate to that.
Oh yeah. It's true. Yep.
Yeah. Okay. So, kind of just going back, recapping, you guys were very, very successful engineers. You have to move, you go to a Rich Dad, Poor Dad, a Robert Kiyosaki seminar, over 10 years ago. Why real estate? Like, what was it about maybe the conference or as you were learning about real estate, why'd you pick real estate as opposed to maybe a franchise or stock market or something like that?
I think I had a really good appreciation for the economics of real estate. Just this simple fact. I mean, it seems obvious today now that we work in it full time, but the simple fact that everybody needs a place to live, there's always going to be a demand for housing, whether it's high or maybe it's not as high, but it's always going to be there. And you just, as inexperienced as we were back then, you could still come to the conclusion that not every business venture had the same economics, supply demand, just simple supply demand success. And we could definitely see that. I think for us, and it's probably similar for most folks that get into the business, for us, it was the way we were raised and our early career life. Real estate just seemed like, oh, that's not something you can do. You're a normal person, so you can't do that. Yeah. And you had to get over that hump. But for us, I think it was very clear that the economics made a lot of sense.
I love that. And you said something I actually kind of want to dig into a little bit. Earlier in life, you said, I'm just a normal person, which you're not normal, by the way. You're very bright. But a normal person buying $30 million apartment complexes. I'm sure, 15 years ago, yeah, right. That's not me. I can never do that. Can you talk about why you as a normal person, me as a normal person, the audience just as normal people, you don't have to be billionaires to do this, but do you want to talk about maybe why and how a normal person can buy a $30-40 million property?
Yeah, and this is what is so unique about multifamily and the group purchasing structure is that it allows us all to leverage each other's money. It's OPM, other people's money. And when we think about a 20, 30, $40 million property, we say, well, I can't afford the down payment. I can't afford the down payment. You can't afford the down payment. Probably none of us listening can on their own, but together we can. When we pool our funds together, we as a collective group of normal, down-to-earth people can buy the apartment complex that you drive by on the highway every single day. And that is such a powerful thought to be able to say, like, this is not a large real estate investment, a REIT, a hedge fund, a foreign investor. This is a group of normal people that can come together and invest in our local real estate and have an impact on the tenants in the community. And so that's one of the things I personally love about multifamily syndication, group purchases. It's because it's the ultimate leverage where we come together. We can't do it without each other. And it's what allows like normal people to say, like, I own part of that property.
I love that. And it's funny because my very, very first apartment deal, I think I own 0.01% of it. It probably equates to like a faucet in one of the bathrooms, but for me, when I did that, I was so I got goosebumps. I was just like, I own part of an apartment complex. And I felt like at that point, I kind of started my journey to achieving financial freedom of time to do what I want when I want. And Emily, I love kind of the phrase you use, the group purchasing structure. So in syndication, kind of like the elevator pitch is we pool money together to buy an asset that none of us could afford by ourselves, right? Mm-hmm. And so Emily, I love the way you kind of said that. And I'm sure in some of your syndications, you're in 23, I believe is what I said, but in your 23 syndications, you probably have teachers in there. You have nurses in there. Obviously, you're going to have doctors, lawyers, engineers, pilots, things, people like that. But you also just have everyday people that kind of see the benefits of real estate, whether they're active or passive. The great thing about the passive side of investing in a group purchasing structure is you still get all the benefits. You still get the depreciation. You still get the cash flow. You still get all of those benefits. And you don't have the stress of, I got to go check out the property, or I got to do the front end or the back end. And so that's where kind of you and your team comes in to handle the day-to-day, the week-to-week. And you do leverage professional property management companies as well, professional construction companies. But your passive investors, they don't even have to see the property. And so that's the beauty of the multifamily syndication. So yeah, thank you for going over that. I love that it kind of sounds silly to say that just a normal person can buy an apartment complex, but it's true. You don't have to have X amount of net worth. You don't have to have X amount of experience. You can go in there, not, maybe like you guys, just going to a seminar or just meeting someone in line for coffee saying, hey, I didn't know I could buy an apartment complex. You exchange information, you have a call, they can invest in the deal with no experience needed whatsoever. So I love this structure. So we talked about why real estate just kind of made sense, the economics of real estate, shelter, it provides a basic human need of shelter. Why do you think, or what makes real estate so attractive to the two of you?
So for us, I believe beyond the economics of it, it lets you take advantage of a market, and everything that it provides, job growth, population growth. Emily touched on this a little bit, but it also allows you to give back to the community. We don't just buy these properties and operate them. We invest millions and millions of dollars into each of the properties. It allows us to improve the value. Buying a multifamily community is kind of similar to flipping a house, so to speak, right? You help increase, you provide investment funds to help increase the value of the asset. And in turn, people who have been living at the property for years and years see their community flourishing. They see things getting repaired. They see that, we generally invest anywhere from $1 to $3 million per property, just refurbishing everything, exterior, interior. And so there's a real big feel good aspect to this business as well.
And one of the things that I love is that even personally, I've experienced this, the amount of control that we have to make adjustments when the market dictates. And the example I use is I invested in GE stock a lot. When I worked there, like all my retirement money was going into GE stock. And I have no control over how GE stock performs. Like it could tank, it could double, whatever it does, I have zero control.
Yeah.
But in multifamily, when COVID happens, when government shutdowns happen, when different things happen, we have a lot of control and we can fine tune our strategy, and we can work very closely with the property managers to make sure that the property and the tenants are still taken care of and that the asset still maintains its value. There is so much more control of our invested funds than by just placing it into a stock or mutual fund where I can't control anything about what performance that does.
Yeah. I mean, somebody, going back to your point, Charlie, about somebody meeting us or meeting a syndication group and investing their hard-earned money. I mean, if they wanted to, they could call those folks and talk to them or they could go to the property and see what it looks like and understand, hey, here's where my $100,000 is at work, right? And get a feel for that. Where you to Emily's point, you can't get that in every type of investment like you can in real estate. It's a very tangible asset.
Yeah, I love that analogy too, because if I'm putting money away in my 401k, who do I call to figure out how the GE's doing? Do I call my financial advisor? Do I call the fund manager? Do I call GE? Doesn't matter who I call. No one's going to call me back, or at least tell me, yeah, we think GE is going to do great, but we can't control it.
Right.
But to your point, Adam and Emily, the control. You can call whoever your partners, whoever that kind of got you into that deal. You can say, Emily, what's going on with this property? By the way, you guys probably send out monthly updates or at least quarterly updates as well that break down the numbers, kind of go over the projects that are going on, occupancy, all that. So you would already have a couple page email with financials that give you more information than you probably need to know about as a limited partner, but it's there. Good luck getting that from a 401k or a mutual fund. So love that control aspect as well. And it's control from a limited partner, from a passive investor side, because you can go to certain people to get information. And then from the active side, you literally can control so much with the property and the business plan. So I love that benefit of real estate. Love to kind of get into how you guys got into the first deal or two from a passive side. How did you come up with the capital to do that? Maybe savings, 401k, different things like that. Do you mind talking maybe about the first deal or two, whatever has a nice story?
Yeah, the first passive deal, we actually used my 401k retirement funds that I had from GE because I had left a couple years prior. And so I rolled that into a self-directed retirement account. And to me, it was just less scary to use that money because I knew that that money had been set aside for investing.
Yeah.
Like it's going into stocks, mutual funds, or some other investment. And after we had learned the benefits of real estate, it's like, why not real estate? And so I had about 175,000, and we took it and split it up into two passive investments, 75 a piece ish. And that was our first LP passive investments. Now, the lesson that we did learn is we also made another one with Adam's his solo 401k. So 3 investments in a very short period of time. And what we learned is we actually probably made them a little too quickly. So one of our biggest lessons was we had met these sponsors, but we didn't quite do all of our homework and check the track record so much. And so the first 3 deals that came in our inbox, we invested in, we deployed our money because we were so excited. And one of the couples did not have a great track record. They had purchased properties, but they never sold any. And they ended up kind of dropping the ball and moving out of the country. And that was our worst passive investment to date out of 17 total passive investments. So just a word of advice to make sure that the person you're investing with has a track record of success in like selling properties, because it's, you get very excited and you want to deploy the funds as soon as you can. But it's really important to deploy them with the right people in the right location markets.
Awesome. Yeah. Thank you for that story. I'd love to maybe dig in a little deeper and see if there's anything that either of you have to maybe, I think a lot of people would understand a track record, but what would be some questions that the audience could ask if they hear they hear about this, or they hear your story and want to talk to you? What are some questions that you think they should ask?
So I think the track record resume is a big one. And by that specifically, it's, where are your investments? How have they performed? And when you have, hit an exit strategy, or when you've exited a deal, whether it's through a capital event or a sale, how have the return on investments been versus what you projected? So that's a big one, right? And like for us, specifically, we have a PowerPoint slide that just breaks down all the deals that we've done and what the returns have been, in case anybody's interested. And then another big topic, is really more geared towards business philosophy. In today's climate, I think it's important to understand where a sponsorship team is on liquidity, and what their philosophy is on balance sheet, because probably today more than ever, with interest rates where they are, a lot of deals are requiring infusion of capital and money to be close by. And you want your sponsorship team to have that money sitting in the bank, ready to go. So that tends to be, I would say, a big topic. And I would encourage anybody to ask those kind of questions. It doesn't have to be like, hey, how much money you got? It's, hey, what are your thoughts on liquidity? And, what does, based on your business activity, what type of liquidity do you feel like your team should have? So I think those are 2 big ones.
And I think it's perfectly fine to ask for a referral to talk to somebody who has invested with them before, because if they're not willing to give you the name of somebody who's invested with them, then their investors probably aren't very happy.
Yeah, sure.
And when he said like exit and sale, the term that we use in the industry is full cycle.
Yeah.
So properties that you've bought, you've improved, and you've sold, or potentially refinanced, but prefer sold. And so full cycle deals are very important in my opinion.
Love that. So for the audience, I'll just kind of recap that really quickly. Adam had mentioned where are the properties. And Adam didn't really go into this, but maybe you want to add another couple sentences, like why is that important?
Well, besides the team that you decide to invest your money with, a big consideration is where where the properties are located. That's it. Going back to control, the passive investor has 100% control over that. You know, hey, I really love Phoenix, so I'm going to meet good, reliable syndication groups in Phoenix, and I'm going to invest my money there. So, you know, if you meet a group and you're networking with them and getting to know them and their track record, if they don't do deals in Phoenix, then, and you've decided that's where you want to do business, well, then you're not going to work with that group.
Right.
So
perfect. Thank you. How have the deals performed? Exit, kind of the exit strategy. What's the return versus what's projected? Because anyone can project whatever they want, right? And so
anybody can buy a deal.
Yeah. What's the actual versus what was projected? And then the business philosophy, is there liquidity? What's the balance sheet look like? I would also add, something to that of what's the strategy. So how many years is the investment? Is it is it heavier on cash flow, heavier on appreciation, or some type of combination? And then ideally some of those, and Emily said the term full cycle, meaning they've sold, they've refinanced, but basically their business plan's completed and they've exited the property. And then the fifth piece is ask for referrals. So love those tips of how a passive investor can check the track record and success of a syndication team. And I guess I do want to point out one other thing too. If Emily, Adam, when y'all first started, you didn't have a track record, but we did, we talked about this 10, 15 minutes ago of there's a whole team behind it. It wasn't just the Emily and Adam show. It was a whole team. And so I do think that if someone were to, in your first deal, check your track record, you say, well, look, it's not me, this is our first deal, but the entire team's track record is A, B, and C. And so just for the audience, I don't want you to be upset or scared if maybe your sponsor, that the person it's their very first deal, because it's not going to be their first deal by themselves. There's a whole team behind them. So just wanted to point that out. What are the company goals for A&E over the next 9 to 12 months?
So we have a great database of passive investors. We love working with people and helping others build their wealth. And our goal is to expand to offer different opportunities. So we want to offer passive investment opportunities in both multifamily and passive investment opportunities in other real estate sectors. The next one's going to be notes, mortgages. And they really have different pros. They have different advantages and strengths. Multifamily is great for large gains over 3 to 5 years, but the cash flow has been a little squeezed in the past year or two. And that's where notes can come in. And so notes have great cash flow, but they have less gain on the back end, less appreciation like multifamily. And so our goal over the next year or two is to really help diversify the opportunities that we can provide to our passive investors and be able to say, okay, for those of you who want steady cash flow, we have an opportunity over here. For those of you who want potential, hard real estate assets with big value gains, we have these opportunities over here. So that's where we're taking our business. And we are personally diversifying between both of those asset classes as well.
I love that. And I think that's, as I talk to more of my investors, especially recently, the last few months, people are looking for more of a steady cash flow that maybe multifamily didn't provide to begin with, but now with higher interest rates, it's definitely not providing. And so now it seems like very little cash flow. But then you get a big capital event in a few years, and that's great for some people that want to build wealth, but that might not be great for someone over here that is about to retire and is just looking to augment their retirement or things like that. So I love that you are diversifying. And we'll, in a little bit, when we go over your website and all that, I'd love, and I'd encourage the audience to reach out to them if they're interested in learning more about that. about diversifying into notes and mortgages, because I think that's a really, really cool way. It's, again, you're investing in real estate. You guys probably get a lien on that as well. And so there's very little risk in that. So if they don't pay, you guys get a home or the property. So there's a lot of benefits to that. As Emily pointed out, you're giving up maybe the big gains, but you're getting a steady cash flow. And so there's no problem if you wanted to diversify and go that route. So that's really cool. How long have you been looking into that or doing that, I guess?
Yeah, we really started to explore it late last year.
Okay.
I would say seriously. And then earlier this year, we joined a community of folks who focus 100% of their energy on note investing, because, as the story goes, right, I think with multifamily, we did the same thing. We didn't start going out and doing deals on our own. We didn't, try things and bring a lot of investor funds along and invest people's money without the proper education or network. So we did join a network of investors to help with the education component and help get us into the right network. And we actually, recently just made our first note investments personally, like between Emily and I, because like Emily said, we plan to bring this to our investors later this year within the next 6 to 12 months. But it's very important for us when we do that to look back and say, hey, here's what we've been able to do with it, because I'm fully expecting our sophisticated investors to say, well, how's it been working for you? What's your track record? Right.
Yeah.
So we just made those investments recently. So far, so good. So
that's really cool. And I think, Adam, you mentioned joined a mentorship group for that. There's obviously going to be some initial barriers to getting into something new, right? And so one of the very cool things about mentorship groups is you're paying someone to teach you what they know, and you're not spending all that time learning it yourself. And then you have coaches and mentors you can rely on. Was there anything else maybe that that helped you guys break down the initial barriers besides mentorship groups?
Finding the right partner in terms of multifamily, and talking about buying our first large multifamily was 180 units of a $14 million property. So going from little single family flips and rentals to 180 unit, we could not have done it without that experienced partner that you mentioned, Charlie, because that literally helped us break down barriers. And finding that right partner who was willing to work with us, lend his resume, lend his relationships with the brokers and the sellers and the lenders, we could not have done it without him. So it's really a team sport. Multifamily is very, very much a team sport.
And the mentorship programs are great. I mean, as you mentioned, Charlie, there's an investment, there's a time and capital investment, but it gets you in the right room. It gets you in the network to meet those folks. We wouldn't have met our partners that we work with today, or our first partner that we worked with in multifamily, had it not been for the group that we joined. And we feel the same way about this new venture that we're exploring with the notes. So
yeah, that's great. I know breaking down the initial barriers, it can be really, really difficult if you do it on your own, or even as a couple, it'd be difficult for the two of you to do it by yourselves. But when you have that paid mentorship, or a mentorship in general, but usually when it's paid, there's also a huge network that comes with it. So I think that's extremely valuable. How do you think your previous profession as engineers helped you in real estate?
We did a lot of project management, as you mentioned. And so when I was working at GE, I was managing welders, machinists, sheet metal formers, painters, but there was still a quality, a cost, a safety aspect, a timing. And then you go over to the multifamily side and you realize it's project management still.
Yeah.
And even in single family, it was managing roofers and flooring guys and foundation guys and painters. And timing and quality and cost and all of that. So that really played a role. And then I would say some of our people leadership training that we got at GE really helped us form the skills needed, because in multifamily specifically, when you work with that property management company, you're not their boss.
Right.
Like, you're the customer, but the leasing team and the maintenance guys, like, you are not their direct report. And so you have to lead and encourage people and motivate without being a direct supervisor.
Love that. And it totally makes sense that your asset managers, because you kind of did that at GE as a project manager, and you just transitioned from maybe airplanes to apartments.
100%.
Yeah,
Yeah.
that's awesome. Very cool. And what would you say to other engineers in your field, maybe that you worked with, to kind of get them interested in real estate, or how would you provide education to them?
Yeah, I think the most important paradigm shift to have, if you're working in a field like we worked in, was real estate can provide that initial backup plan. And this probably applies to multiple fields, but where we worked, and we experienced this firsthand. Our industry, the aerospace industry, was extremely susceptible to market cycles. There was 9/11. And then there was the housing crash, which, the housing crash affected the aerospace industry just as much as it affected the housing industry. And so for folks in that field, especially, guys and gals just getting out of college with their technical degrees, real estate is a good thing to explore because it provides that initial backup plan. I mean, it may not replace your W-2 income after, participating for 12 months, which it didn't for us either. But it's the start of something, and you can build on it. And after, in the time that it takes our economy to cycle, you can really build something really, really big, and still have your full-time job. And hey, if something happens at work and the market cycles and I'm no longer needed, well, it's a good thing I've got a backup plan, because I was looking for a job when I found this one. Right.
Yeah. I love that. And I do think, not just engineers in the aviation space, but a lot of other people like to have a backup plan, and it's typically another job, right? It's another W-2 somewhere else. And I think what's really important is to have a backup plan, have multiple streams of income, a way to diversify. And, Adam, just to kind of add something to what you just said, I love math. I'm a nerd, but a couple of weeks ago, I said, okay, if I were to take a $50,000 initial investment, and we, our team and your team likes to, double investors' money in 5 years. That's what we project. That doesn't mean it happens. And Emily and Adam, I think you said you had a one pager with actual returns that are probably a lot more aggressive than what you had forecasted. But if you were to double your money every 5 years, you do that for 30 years, you take $50,000, you turn that into $6.4 million. That's after one investment and just reinvesting that. And so if you
crazy.
It is. And that's one investment. And that does not include taking the cash flow and reinvesting that as soon as you can. That is just reinvesting after a 5-year period. And so, that's a really good backup plan for a lot of people. If they can invest one time, and they could do whatever they want with the rest of the money, but then reinvest when they retire, they're gonna have $6.4 million. Tons of tax benefits, stuff like that. We're not CPAs, but anyway,
I think anybody would sign up for that type of return over a professional career.
And how much work are they doing on those when they're passive?
They just have to find the right people to invest with. That's the easiest but most important work.
Yeah, totally agree. All right, so want to move into kind of the closing point of the interview. What has been a recent book that you both have read that stands out, real estate, self-help, business related?
So one of the books I had to read for the wealth mastermind I'm in was called The Banker's Code. And it's by George Antone. And I read it first, and I went to Adam and I said, sometimes there's a book you read that kind of defines your decade. And I feel like Rich Dad Poor Dad was that book for us last decade. And I said, this might be the book that defines our next decade of investment strategies, mindset, family legacy planning. And he read it, and I think it really has given us a new mindset with how to view our investments, our legacy, being our own bank. It's concepts that I had never, ever heard before. And so I was really impressed with that book, and I'm so grateful that I was given the task to read it.
That's great. Someone actually recommended that book on this show a month or two ago, and I believe they may have a second book as well, or like a sequel to that or something. But
good. I'll have to look into that.
Yeah, I'll have to look at my notes. But Adam, is there anything, or would you second that Banker's Code?
Yeah, recently, I mean, of all the books, and we like to read a lot, that's got to be, it's been a huge game changer.
Cool.
Yeah.
I am reading a really cool other book right now. I'll give a shout out. It's called The Dream Manager. And at first I was like, oh no, not another book on how to be a good manager. But it's by, I think, Matthew Kelly.
Okay.
And
cool.
It's pretty cool story, and not your typical like management book.
Okay, so The Banker's Code and The Dream Manager.
Yeah.
Awesome. Okay. What can people expect to see from you both and in your business over the next few years?
So we're still going to be pretty heavily involved in multifamily investing and providing multifamily investment opportunities to the investors that we work with. And like Emily mentioned, we are very aggressively pursuing a diversification model for our own wealth plan. And we very simply, we don't make it complex. Whatever we do for us and our family, we provide the same opportunity for our investors. So we're going to be moving pretty aggressively into other forms of investing, more cash flow heavy forms, mortgage notes. So multifamily apartments and mortgage notes.
Love that. Lead by example. You're the guinea pigs to kind of try something new, and when it works for you, then you spread the word to your investors. Love that. How can people reach out to you if they want to talk about notes, if they want to talk about being a pilot, anything, if they want to, and we didn't even really touch on that too much, but
meet me at the airport.
Yeah. But how can they learn about your investments?
So the best website right now is www.ae, like Adam and Emily, aemultifamily.com.
Okay. Perfect. And I know you're both on Facebook.
Mm-hmm. Mm-hmm. We are.
Cool.
Yeah.
So we'll put all that in the show notes. And then any other social media that you wanted to call out or highlight?
We've got an Instagram, AE Multifamily.
Okay.
But yeah, Facebook, as far as a quick reach out, that's an excellent thing. We check that Facebook Messenger and respond quickly.
Cool. Okay. We'll definitely put that in the show notes. Adam and Emily, it was so great to talk to you both. I love that you were both extremely successful, wanted to basically be the co-CEOs of GE one day, and then you went to the same seminar I did and said, no, we don't want that anymore. I love that you're married, you're partners in the business and in life, and get along so well. And in real estate, both, maybe you stepped on toes, but you took a step back and figured that out. So I love that. Thank you so much for being on the show. I really, really appreciate having you.
Yeah, we're honored to be on, Charlie. Thanks for having us. This was a lot of fun.
Yes, thank you so much.
Absolutely. Have a great day.
Bye.
Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing. Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.